Hello, this is Mijun from Big Juicy Lawn University. Let's begin today's Big Juicy news for September 29th. Welcome to Mijun, where we continue to uphold the fundamentals of investing in United States stocks as always. There are only 2 days left in September, and I can't remember much because the month went by so quickly. In my case, I think this feeling is even stronger because I recently moved to a new place. I hope you all finished the last 2 days of September well and greet October with a hopeful heart. In the history of the United States stock market, October, November, and December are usually very positive months with strong upward trends. I hope that the history of the United States stock market repeats itself in 2025 as well, and I will wrap up the third quarter well. As we welcome the final week of September on September 29th, let's begin today's big stock market news. September. Just like during the holidays, I was reading each of your valuable comments today as well, and there was someone who left an unexpectedly very valuable piece of information. Someone is using identification agent 21. I was almost completely fooled. This can't be it, right? You said the voice sounds exactly the same and left a link here. When you click on this link, it takes you to Mijun's channel, but there's a problem, right? If you look here, they're advertising a book I wrote and the photo is the same. The name is also Mijun. But the problem is, there are only 2 subscribers and there are only 4 videos in total, including shorts. So you might notice that something feels a bit off. Let's try clicking on it. This is Mijun retiring through staking. Today, I can confidently say that this is an opportunity that can completely change your assets. Well, that's not the language I usually use, but I can confidently say that it can grow your assets. Well, I don't usually promote things like this. Anyway, I think today we can see some of the downsides of artificial intelligence. Since the technology is still lacking, it matched my appearance perfectly from a photo, but the voice sounds a bit off, right? But technology always has the potential to improve. It seems that the day is not far off when artificial intelligence that looks like us and even has the same voice will be active. So, from the perspective of investors like us who are focusing heavily on artificial intelligence technology, we started to think that social problems are becoming quite serious and that we need social safety measures to prevent potential harm from artificial intelligence in the future. Anyway, I would like to once again thank Agent 21 for sharing such valuable information with us. For your information, after seeing this comment, I immediately reported it to the YouTube legal support team. Back in November 2020, I registered a trademark under the name Mijun. At that time, I registered the trademark without much thought, but looking back now, I think it was a really necessary safety measure. Alright, like this. Because there are people like you protecting me, I feel a bit more at ease and can focus on the Mijun channel. Alright, let's begin and summarize hopes for the United States stock market. The screen you're looking at right now, this is the S&P 500 map from last Friday. So the atmosphere on Friday was really good. There were very few stocks that went down, and you can see that there were a lot of stocks that went up. So why was the atmosphere in the United States stock market so good on Friday? The core personal consumption expenditures was announced, and unlike the market's concerns, the figures were presented in a favorable direction. Let me briefly explain this part. Now, the personal consumption expenditures price index is up 0.3 compared to last month, and the forecast was also 0.3. And what's even more important is the core part in front, the core. The core personal consumption expenditures also only rose by 0.2%, and the forecast was also 0.2%. So it matched the market expectations exactly, and it's the same compared to last year. 2.7%, and the core personal consumption expenditures is plus 2.9%. This also matched the market consensus exactly. If you look at the last part, it says real consumer spending, right? Just to remind you, when you see the word real in front of something, it means inflation has been considered. By factoring in inflation, we're examining consumer spending patterns like ours. Compared to last month, it actually went up by 0.4%. The market forecast was plus 0.2. Therefore, people are spending more money than the market expected, which can be interpreted positively. Thanks to that, last Friday, the United States stock market turned blue for the first time in a while. Stocks with smaller market capitalizations generally showed a strong trend. Now today is Monday, so let's briefly review the market conditions from last week before we move on. I've changed the S&P 500 map to show the past week, and as you can see, it looks quite different from the map we saw on Friday. You can see a lot of red, and among the large cap stocks, there are quite a few that have dropped significantly. Especially in the case of Oracle, it plunged by as much as 8.16%, Broadcom dropped by 3%, and Google also fell by more than 3%. Well, but in a way, I don't think this is a big problem. Because if you look at the monthly returns, as you can see here, Oracle, which dropped the most, is still up over 20%, Broadcom is up 11.4%, and Google is up 18.7%. To put it another way, the stocks that fell sharply last week were those previously on a strong upward trend and just had a technical correction. Some funds flowed out and moved to other stocks, so you can see this kind of rotation happening. So, the fact that money isn't completely leaving the market but is moving to other stocks means there's still no problem with liquidity. Therefore, if stock prices fall, there's a chance that the money could come back in, so you can interpret this positively. Over the past week, most indices recorded negative numbers, but only one index ended in the positive. It's the microcap index. As you can see recently, microcap stocks have been maintaining the strongest momentum. Let's take a look below. As you can see, except for energy, utilities, and real estate, all other sectors had a weak week, showing negative returns. Next is market breadth. On Friday, we were at a very important moment. The market breadth dropped below 50%. That was true when considering the short-term trend. If we check again this time, the stocks with good market momentum, which were at 47%, have now risen to 54% and 67%. Also, the stocks with good long-term trends have increased from 59% to 62%. Therefore, as the number of stocks trading above the 200-day and 50-day moving averages has increased significantly, it once again confirms that there are still no issues with the market's momentum. And the volatility index has also dropped again, falling to 15.29. Over the past 2 or 3 days, the volatility index had been rising a bit, but as it dropped back down to 15.29, it shows that a calm atmosphere still remains in the market. There are still no issues with volatility, so we can conclude it this way. This is the Fear and Greed Index. It rose slightly to 53. I've repeatedly said that it's good for it to move back and forth between 50 and 75. It almost dropped all the way to the bottom. Luckily, the Fear and Greed Index, which nearly hit 50, is climbing again. So if it doesn't break through 50 this time either, then we can expect the possibility of it going back up to the top of the box again. Meanwhile, the market score fell further to 72, placing it at the upper end of the ripe stage. I want to say that we need to keep watching this indicator. Let's review Mijun's top picks performance. First of all, Mijun's top picks are not 20 stocks, but 19. I forgot to mention this on Friday, but I have excluded Astara Labs for now. Recently, a fundamental issue has come up, so for now, I've excluded it from Mijun's top picks. If we find additional investment information in the future, we may add it back in, or we might exclude it permanently. Among Mijun's top picks this week, there were very few stocks that showed a positive return. At the top, Polisola was up 3.5%, which was the best performer as it went up. The second best was Tesla, which also did very well. It ended with a 3.36% gain. Third was Taiwan Semiconductor Manufacturing Company with a 3.21% gain. Advanced Micro Devices was up 1.32% and Nvidia rose 0.86%, making it onto the list of stocks that showed a positive return. All the other stocks ended in the red. Vistra fell 1.92%, Palantir 2.64%, Tallinn Energy 2.91%, Broadcom 3.02%, Google 3.12%, Celestica 3.61%, and Meta 4.45%. Bitcoin dropped 5%, closing at 111,790. Next, Coinbase was down 8.72%, Strategy down 10.35%, and B2 down 10.63%, Credo down 15.71%. Lastly, 18.7% performing the worst. The good news is, in the case of the Ethereum exchange-traded fund, it showed signs of recovery by surging more than 6% last Friday. I think we need to keep watching to see how things develop going forward.
See you in the video.
I'm going to read a few more comments left by our United States China subscribers. First, this is a comment left by someone using the identification Kim Jong-yol. A rate cut is good news, so why did they sell so much of their long positions? This is what the question is about. According to last Friday's broadcast, recently fund managers and institutions have been selling more than buying, right? The question is, what is the reason institutional investors are selling off their long positions like this? That's what they're curious about. Each investor has different goals, right? This is a very important point. For example, among you, if your goal is to make an average annual return of 10%, what should you do? You just need to buy the S&P 500. Because historically, if you look at the averages over the past 10, 20, 50, or even 100 years, the United States stock market, that is the S&P 500, has had an average annual. So if history repeats itself, just buying an exchange-traded fund that tracks the S&P 500 could give you an average return of about 10%. But if you think 10% is a bit lacking because there are people who are at a stage where they need to build wealth, so, depending on the stage of life, some people are in a period where they need to grow their investment funds, while others are in a period where they need to preserve their investment funds. If you still have a long way to go before retirement, and the amount you have invested in stocks is relatively small, so you need to grow your funds significantly before you retire, then for people in this situation, 10% feels a bit lacking, and you want around 20%, so there are people who dream of achieving the returns that Mijun aims for. Expecting 20% returns from just investing in the index is unrealistic. That's why you need to build your portfolio mainly with tech stocks and invest in individual stocks. Then you need to consider the position of institutional investors who have sold a lot of long positions and think from their perspective. Usually the goal of fund managers is not to maximize clients' money or to achieve 20% or 30% annual returns. From their perspective, they've landed a really good job, studied hard to get into a good university, and now they have the title of fund manager that others envy. Their goal is how to survive in this institution for a long time, right? So, beating the market returns and making 2 or 3 times the market returns isn't what they want. What they really want is this. How can they make sure clients don't complain and generate a reasonable return? An average annual return of 7% or 8%, maybe matching the market returns if they're lucky. This is the position of fund managers who pursue safe investment strategies. This is something we need to think about. That's why, when a major negative event is expected in the market or uncertainty arises, they naturally need to reduce their positions. And, as you all know well, this week there is a high possibility that the United States government will shut down. So if the United States government does shut down, the United States stock market will fluctuate significantly. Therefore, during times when there are such risks, it's only natural from their perspective to reduce the proportion of stocks. Because from their perspective, their goal is to survive and not get fired. I think this is something we should keep in mind. Let me read one more valuable comment. This time, it's a comment left by Han Song-hoon right below. He asked a simple question. Isn't this a bubble? So, the United States stock market has been on an upward trend for a very long time recently, and that's why many experts are diagnosing it as a bubble. And according to the hot-off-the-press article released today, it seems very likely that this is a bubble, because the Buffett indicator has surpassed 200%. So what does it mean that the Buffett indicator has gone over 200%? And as investors, does this mean we should sell all our stocks? I'd like to talk a bit about this. Let's review this article's contents. The stock market valuation indicator that Warren Buffett once preferred the most has reportedly hit an all-time high. Therefore, concerns are rising that investors are again testing the limits of market overheating. This is called the Buffett indicator, and in English it's known as the Buffett indicator. This indicator measures the total market cap of all United States public companies against the country's gross national product. Gross national product was commonly used before, but now gross domestic product is used more for comparison and measurement. That's how to understand it. This index actually first appeared a long time ago, in 2001, so that's 24 years ago. In a column for Fortune, Buffett said this. He highly praised this indicator, calling it the single best measure of valuation levels at any given time. Since then, the Buffett indicator has become very popular. Buffett mentioned this in a speech in 2001. If the ratio of this indicator falls to 70% or 80%, buying stocks will work very well. So that's considered a buying opportunity. However, if this ratio approaches to 100%, it's like playing with fire. He's saying that the market capitalization has gone up way too much. And for example, in some periods of 1999 and 2000, in fact, there was a time when the Buffett indicator actually went up close to 200%, and then the dot-com bubble burst. The figure has reportedly climbed to 217%. Therefore, it has far surpassed the peak during the dot-com bubble and the pandemic rally. It's a very dangerous situation. Now here is the Buffett indicator. Back in 2000 it peaked here and then the dot-com bubble burst. But now it's at a much higher level compared to the dot-com bubble. Therefore it's very dangerous. Indicators like this make people think we should sell our stocks and get out now. Other valuation indicators are also giving similar signals. According to Bespoke Investment Group, the price-to-sales ratio of the S&P 500, which we call the price-to-sales ratio. What about the price-to-sales ratio indicator? Recently, it rose to 3.33, reaching an all-time high. So what does this mean? There are the top 500 companies included in the S&P 500, right? If you add up all the revenue these companies have generated over the past year, and then you compare the total market capitalization of the S&P 500 to that. When you do that, you'll see that the market capitalization is about 3.33 times higher than the total revenue generated by these companies. Now, 3.33 surpasses both the dot-com bubble in 2000 and the post-COVID surge, which peaked at 3.21, showing the market is more expensive than ever. However, some people argue that the Buffett indicator may no longer have the same significance as it did in the past. Over the past 20 years, the United States economy has shifted from being asset-intensive to focusing on technology, software, and intellectual property. Now, I'll explain this part in more detail in just a moment. What about gross domestic product and good manufacturing practice? It's highly likely that they don't fully reflect the value of the modern economy, which is driven by data, networks, and innovation rather than physical assets like factories. So, in the case of the United States, which has the most productive and innovative economy in the world, there's an argument that higher stock valuations can be justified. And Warren Buffett hasn't mentioned this indicator for years, so it makes you wonder if it's no longer a valid indicator. Nevertheless, Warren Buffett still... In the past 2 years, Berkshire Hathaway has been accumulating a large amount of cash. According to the second quarter earnings report, their cash holdings reached $344.1 billion. They've been net sellers for 11 straight quarters. For 11 quarters over 2 years, Warren Buffett has steadily cut his stock holdings. By the way, I did some calculations. At the end of Q2 2025, Berkshire's total assets were $1.124 trillion. So it surpassed 1,560 trillion won in Korea. So the ratio of cash holdings to total assets is about 39%. I don't know what your cash ratio is, but right now, Berkshire Hathaway's cash ratio is over 30%. That's how you should see it. Now, Berkshire Hathaway also holds publicly traded stocks, and the value of these holdings is about $257.5 billion. That means only 22.9% of their total assets are invested in stocks. That's something we can observe. I'm showing you this for an important reason. Sometimes some of you say things like, I currently have about 20% in cash and I regret not putting it into stocks. Or watching stock prices go up, I really regret not investing 100% in stocks. I see comments like this from time to time. Now, but if you look here, for Berkshire, just 22.9% of its assets are in stocks. Investing all your assets in stocks, especially risky ones, can be very dangerous. Great investors never do that. I just wanted to show you this part briefly. I'll end with a final word from Mijun. In my opinion, the Buffett indicator is no longer an absolute indicator for buying or selling United States stocks like it was in the past. Now, the reason for this can be explained in two ways. First, the change in the economic structure, and second, the rise of tech stocks. First of all, as briefly mentioned in the article above, the industrial economy in the past created value based on physical assets like factories and equipment. And this was well reflected in good manufacturing practice and gross domestic product. But what about the current economy? We are now in an era where value creation centers on intangible assets like software, data, platforms, and brand value. And the value of these intangible assets is difficult to be fully captured in the current gross domestic product statistics. Therefore, when comparing the two, you can see that there is almost no correlation between them anymore. Now, one more thing. Big tech companies and growth stocks dominate the United States market by market cap, valued more on future cash flow expectations than current profits or assets. Now, as for the market reflects their future growth potential in prices several years in advance, and Tesla is a prime example. Tesla isn't even selling cars well right now. Nevertheless, the stock price keeps going up. That's because future growth areas like robots, autonomous vehicles, and taxis are already priced in. Now, what that means is comparing it to the current gross domestic product, so comparing a company's value to the current gross domestic product, structurally, this inevitably results in higher valuations. That's the problem. Now, on top of that, a handful of giant tech companies, for example, the Magnificent Seven, their share of the total United States market capitalization has become overwhelmingly higher compared to the past. Now, why is this a problem? Most of the megatech companies listed on the United States stock market generate profits from all over the world. There aren't any companies that make profits only in the United States. So the market capitalization, the numerator, includes a significant contribution from overseas profits. But in the denominator, like good manufacturing practice or gross domestic product, only United States domestic production activities count. So structurally, it doesn't make sense to compare the two. Because of this structural mismatch, the Buffett indicator has a structural problem where it naturally rises as American companies expand globally. In other words, the high valuations of these multinational mega tech companies are being transferred. In the end, this has pulled up the entire index, causing a distortion that structurally raises the Buffett indicator. So, as time goes on, the Buffett indicator inevitably keeps rising. That's how I see it. All right. However, despite that, the Buffett indicator still remains valid as an overall market risk warning. Therefore, it's true that as the market capitalization has risen a lot now, the valuation has also increased. Now, another thing is that there are still quite a few institutions and investors who rely on this indicator when making trading decisions. What that means is that a self-fulfilling effect can occur to some extent. Now, what is a self-fulfilling effect? If people see the Buffett indicator rise and sell their stocks, stock prices can drop as a result. Instead of blindly relying on the Buffett indicator and exiting the market entirely as investors, we should check the risk in our portfolio and take another look at whether we have enough cash on hand. And now, it's best to use this as a reference for creating a more cautious investment strategy, like adjusting high valuation asset proportions. This is my conclusion. Let's move to today's main article. It says this article is a Mijun recommended content, which means I put a lot of effort and time into Mijun's words. That's how you can see it. This article was originally very negative, but I adapted it in a positive way. On October 1st, United States stocks will be available at low prices, presenting a hopeful buying opportunity. All right, let's first take a quick look at the article to see what it's about. What's the good news for the economy this week? In the long term, it will be positive for stocks. This week, a key economic indicator, the employment report, will be released. If it's good, it will benefit stocks in the long run, according to reports. But, just the fact that any economic news is being released at all might be something to welcome. Now, let's discuss what this means for the United States stock market. Despite September being statistically known as a tough month, we've seen good results so far. But now, what about investors? At this point, in the middle of the week, as we approach the end of the month and the end of the quarter, it seems likely that a federal government shutdown, meaning a temporary halt of government operations, will occur. That's very unsettling news. Now, what's important is that due to the shutdown, the highly anticipated September employment report might not be released. This is the part the article calls very negative. According to Kevin Gordon, the chief investment strategist at Charles Schwab, since the employment report is scheduled to be released on Friday, this shutdown could come at a really unfortunate time. He pointed out that if we can't access that data, it will be a big problem. What the market hates the most is uncertainty. But if we've been waiting for such an important report and can't see a report that's released once a month, what does that mean? It means fear might enter the market, especially now there's been intense scrutiny and controversy over recent labor market data. The reason is, as you all know, after a weak monthly employment report was released last August, President Trump suddenly dismissed the head of the Bureau of Labor Statistics. That report included downward revisions to the data from the previous few months. It had dropped significantly. All of this suggests that the United States economy has held up well despite the sluggish job market. However, the new labor market report released every month can cause investors to feel uneasy. What about September's employment report? In particular, it's scheduled as the most important event this week, so a lot of investors are focusing and waiting for this employment report. But if the government shuts down and this report can't be released, United States politics could be greatly shaken. We can understand it from this perspective. And also Polymarket. Polymarket is a prediction site. That's how you can look at it. They're currently predicting a 74% chance of a government shutdown on October 1st. So this time, the outlook is that there's a very high possibility of a government shutdown. I'll end with a word from Mijun. As I've repeatedly said, it's impossible to predict the future accurately, so we shouldn't try to predict it, we need to respond to it. However, by looking at past history, we can deal with the uncertain future more wisely. If we prepare just a little more, we won't be shaken, and we can respond wisely without being psychologically intimidated. To get to the point, historically, government shutdowns have increased market uncertainty in the short term and have sometimes acted as downward pressure. What's important is that, in the mid to long term, the market recovered quickly and continued its upward trend. Therefore, we can sum it up by saying that it's nothing more than a passing breeze. The nearest examples are in 2013 and 2018, when federal government shutdowns also occurred. If we look at the S&P 500 index returns by period from the start date during those times, we can argue that it might make it a little easier to prepare ourselves mentally. 2013 is the first, but coincidentally at that time too, the government shutdown started on October 1st, and back then the government was paralyzed for a total of 16 days. But back then, after the United States government shut down, people were really curious about how the United States stock market would move. The first week was negative. It dropped 0.07% in a day and 2.33% over the week. Not good. But here's the problem. After 1 month, it rose 3.93%. In 3 months, it increased 8%. And after 6 months, it jumped 11.24%. The United States stock market typically rises 10% annually, but it gained 11% in just 6 months, making this increase remarkable. The second is even more interesting. It was 2018, so it was during President Trump's term. At that time, there were actually 2 shutdowns. The first one happened on January 20th, and the second one started on December 22nd. The first one only lasted for 3 days, so let's leave that one out. In the second case, the government was paralyzed for as long as 35 days. The prolonged shutdown overlapped with an economic slowdown, fear, and a liquidity crunch. On the day of the shutdown, which was December 24, extreme fear was reflected in just 1 day. I've written it down here. On December 24, 2018, the United States stock market index fell by up to 2.33%. It dropped. Now, even at that time, what's really interesting is if you look at December 26th, the first trading day after Christmas, the United States stock market jumped up to 4.96% in one day. After 1 month, it rose 11.99%. After 3 months, it was up 19.12%. After 6 months, it surged over 25%. So to sum it up, according to historical data, a government shutdown can be a short-term volatility factor for the United States stock market. However, from an investor's perspective, we can conclude that using this as a mid to long-term buying opportunity has led to better results. Of course, we should keep in mind that the sample size is very small. So from our perspective as investors, we can decide on our cash allocation while keeping in mind both scenarios. The first, where there is no government shutdown and the stock market rebounds immediately, and the second, where a government shutdown occurs and a buying opportunity arises. Depending on the investor, 20% might be appropriate, 10% might be suitable, or for some people, 30% could be the right amount. Therefore, the cash allocation is something each person should decide for themselves. I'll wrap it up like that. Today's final content is the United States stock video. In today's video, there are two experts featured. The first is Dan Ives and the second is Tom Lee. They are both very famous and popular analysts in the United States. Today, instead of an interview video featuring them, we're going to talk about the ETFs they recently launched. For your information, the exchange-traded fund launched by Dan Ives is the Dan Ives Wedbush Artificial Intelligence Revolution Exchange-Traded Fund, and the ticker name is IVES, which uses his own last name as the ticker symbol. Shall we take a look at which stocks are in the top 10? I think it will be interesting. As of September 26, 2025, the stock with the highest holding ratio is Tesla. They're betting 5.35% of the total funds on Tesla. The second is Taiwan Semiconductor Manufacturing Company. The third is Google. The fourth is Apple. The fifth is Broadcom. The sixth is Oracle. The seventh is Alibaba. The eighth is Nvidia. The ninth is Microsoft. And the 10th stock is Meta Platforms. In addition, stocks like Amazon, Palantir, and International Business Machines are also included here. Next is the exchange-traded fund called Grainy, operated by Tony. As you can see, GRNY is the ticker name. And what's really interesting is that the top stock in both ETFs is the same. So the stock with the largest proportion is Tesla. And in the exchange-traded fund operated by Tony, Tesla also accounts for 32% of the current allocation. Second, just like that, Google, which Ives is betting on, holds the second largest proportion. The third is Lam Research, the fourth is Palo Alto, the fifth is Oracle, the sixth is CrowdStrike, the seventh is Caterpillar, the eighth is American Express, and the ninth is KLAC. And Robinhood takes the 10th largest proportion, just making it into the top 10. Today we'll talk about what makes these two ETFs special and how we as investors can make good use of these ETFs. That's all for today's Miljusim News on September 29th. Thank you for joining us for the first broadcast of the new week. If today's broadcast was even a little bit helpful for your investment activities, we would really appreciate your valuable likes and lots of comments. Let's keep fighting together until we retire by investing in United States stocks. Have a happy day. Thank you.
This article is one of the most read articles on the Bloomberg website. It's no surprise. You too are mega tech bulls. You launched an exchange-traded fund. Please explain the basics. That is, what we need to know.
These two ETFs really stand out among the 4,400 ETFs in the United States. That's because they've achieved a rare double performance, excess returns and capital inflows. Often, excess returns don't lead to capital inflows, and capital inflows usually don't result in strong performance. These two ETFs are showing both of these at the same time. Also, both individuals are highly influential figures. Tom Lee has about 500,000 Twitter followers, while Dan Ives has around 250,000. They deliver their ideas directly to individual investors, and those investors are buying ETFs worth billions of dollars based on those ideas.
Their ideas are delivered directly to potential individual and institutional investors. For example, let's say Dan Ives appears on this program. He acts as both a buy-side and sell-side analyst, claiming, "I'm independent." He says, "In my opinion, the stock prices of these companies will go up even more." As a perennial bull, he always expects these companies' stock prices to rise. But what if someone questions their valuation? If at some point he turns negative on a particular stock, will the inflow of funds into the exchange-traded fund still be able to maintain its independence?
This is the trend we're witnessing. Well-known market figures like Tom Lee and Dan Ives are now launching their own ETFs directly. Both of them have a strong foundation thanks to their research. They publish research every day, and if you become a client, you can receive several notes a day. That's what led them to this idea. What if I put my ideas into a single exchange-traded fund so that investors who follow me can buy it with just one click? That's exactly the advantage of ETFs. You can invest easily with just one click. As you pointed out, followers are very loyal and tend to follow trading opinions exactly. There is still the question of whether a conflict of interest could arise, meaning someone seeks their own benefit. I believe they'll uphold their fiduciary duty and prioritize the client's interests, though it's an interesting point. For example, Rubin and GMO have both launched their own ETFs. Even the league leader, who is currently being mentioned as a candidate for the Fed chair, has his own exchange-traded fund. A new wave is rising. Of course, not all celebrities succeed just because they launch an exchange-traded fund, but at least in their cases, it has been successful.
They're basically personal brands now, with people expecting quick stock picks from them. Dan Ives especially stands out as charismatic. Can you describe what kind of person he is to those who don't know him?
Everything he says is quotable. He always appears in flashy clothes and wears a hat. If others are in black and white, he stands out as big, bright, and colorful, just like Tom Lee. They both make bold bets, and their statements are remembered as powerful sound bites.
As much as they try to increase the numbers, realism is inevitably covered on its own. It seems like it was meant to be made into a domestic version, and the unnecessary things that come before the event. These are the keywords. I searched and looked into the sweet ones. There are also offers and advertisements. Let's walk together on this beautiful downhill path. With happy investor Mijun, let's all boldly retire with national stocks and bonds together until that day. A beautiful downhill path. A beautiful downhill path.